Personal finance practice problem using Excel. Loan payment calculation and amortization table. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, going to populate that into the blue area on the right-hand side, looking at a loan situation where we have an imagination of we're borrowing the $11,000. The interest is going to be 5%. Now, obviously, if we are borrowing, interest is, in essence, you can think about it as the rent on the purchasing power of the money. So we're borrowing money. It's similar to it as if we were using basically a place to live, or if we're using basically a place to work and renting that place, we're borrowing the use of it and have to pay basically rent on the use of it. Interest, you can basically think of as the same thing. We're borrowing the purchasing power, have to pay rent for that purchasing power. That's going to be called basically interest. We're going to repay in years, 7 years. So we're going to be making installment payments. We'll be paying yearly. And usually when you're looking at a fixed kind of setup for a repayment of a loan, which is quite common for personal kind of financing options, although note, you could have different financing options when you look at basically like business financing options. But most of the most common things we think about on the personal side of things, we have a fixed set of payments that we repay. Oftentimes we don't repay yearly, we repay monthly. We will take a look at monthly repayments, but that's a little bit more of a twist in our calculations. So we'll take a look at that in a following presentation. We'll start off here with yearly repayments. This would be applicable if you're thinking about like a home loan or something like that, which is often paid off in installments, once again, monthly usually, but similar concept. Or if you're talking about any kind of financing like a car or something like that. Now, first, we're going to be thinking about the payment option, which is often something that you would be thinking about if you're the one that's granting the loan. But clearly, if you're kind of budgeting yourself and you're trying to think about how much money you would want to borrow, then you would want to do a calculation such as this to think about what the payments would be if you could get borrowing at certain terms and whatnot. So that's going to be the kind of concept with it. Once you know what that is, then it's useful to make an amortization table to list out what the actual payments will look like. So that's going to be the idea. Now, if you have this information, we could use the payment calculation, which is a function in Excel, but it's related to, once again, the present value calculations. So oftentimes you might first be most comfortable with the present value calculations, and you might say, how about if I'm going to back into this payment situation, is there some way that I can use basically the present value calculation to do so? So what we might start doing then is to take our data, start plugging it into the present value calculation and see if we can use that with the help and use of the goal seek, and then get a better idea possibly if there's another function related to it, which there is, which is the payment function here as we go. So we might say, okay, let me see if I could start plugging this into like a present value, shift 9. We're going to say the rate would be this 5%. So we're going to pick up the 5% and B2, comma. The number of periods would be 7. So we know that. We know the number of periods would be 7. The payment amount, comma. Then we have the payment amount. And we should have a payment amount because this is basically going to be a series of payment kind of situation. And that's what we don't have. So if I look at the present value, I'd say, okay, I don't have that. I'm going to put that in a cell down here and say that's going to be my unknown. And then the present value, the end result of this thing, we actually know should be basically the 11,000. That should be the starting point. So if I say enter here, we can kind of back in and use our goal seek. And we can also kind of say, okay, I can either use goal seek or I can see that payment thing right there, the PMT, is what I'm missing. Maybe there's an Excel function which is called PMT, and we can do that directly. But considering I know the present value more clearly, I'm going to use it first and use the goal seek to kind of back into what I need. And then we'll verify it with the payment calculation. So I'm going to type in a payment of 1,000 down here just to test it out. And I know the end result should be 11,000. Now I would like the result to be a positive number. So I'm going to double click on it again. I'm going to put a negative in front of the P to flip the sign. So, and then I can start to adjust this. I can say, well, I know what the end result needs to be, that 11,000. If I make this like 2,000 or something like that. I'm getting closer to the 11,000. I can ask Excel to do that for us using the goal seek feature, which would be in the data tab up top, and the what if in the forecast group, what if analysis, goal seek. Let us seek the goal. We want to set then this cell up top to be 11,000 by changing then this data input cell right here. We could say okay. And there we have it, the 1901. So in this instance, then we would have to make repayments, if we're paying them on a yearly basis of 1,901 for the borrowing of the loan. Now, we could also think about that and say, okay, well, I can get there more quickly with just a payment calculation down here. Let's use the trusty payment calculation. This is equal to the PMT, payment shift 9. The rate is going to be over here at the 11%, comma. Number of periods then is going to be the 7 periods, and then comma, the present value, that's our starting point. That's going to be our loan amount. So present value is going to be the loan amount. That's the money we're getting now, and enter. And there we have it, the 1,901. I'm going to flip the sign of it again, making it a positive, double clicking on it. You can do so by putting a negative in front of the payment, which is probably more proper. I like to just put it in front of the P, flipping the whole thing, multiplying by -1 in essence. So now that we have that, we can then do our calculation with our loan over here and do basically an amortization type of table. This is really useful to be able to do, and this will give you, once again, a better understanding. I'm going to make these cells a little smaller here so we can keep all this stuff together. A better understanding of the pictorial picture of what you're basically doing and the interest in the loan balance as we go. It can also help you to record the payments in an accounting system if you're trying to track what your current loan balance is, what your interest is, so you can deduct the interest for taxes and all that kind of stuff. So let's go ahead and say we got year 0, 1. I'm going to select those two cells. We're going to put our cursor on the fill handle and autofill that on down, autofill. And then let's go to the home tab. Let's go to the alignment. For some reason, it's shaded out here. I want to center that. There we go. Center it. Then we're going to say that we have our starting point, which is the loan balance, which I'm going to put at period 0 all the way in column K, which is going to be equal to the 11,000. That's our loan. And we're going to think about, well, what if we had payments on that with the 9% interest, and we're going to make payments on it. Note, this is a common kind of format to set up an amortization table. You might want to practice if you're doing this in a school setting or something like that, or if you're, calculating loans for a home or purchasing a equipment or a car. You might want to set up a table like this and just practice setting up the columns, because that can be a little bit tricky. Once you know how to set them up, it's fairly easy to do this. And again, in Excel, even if you're doing a loan with 30-year payments and whatnot, you could, even if you're doing it by month, 30-year payments, and you got to go down to 360 cells, that's okay. You can copy it down, and then you can figure out what the yearly interest rate would be and whatnot. That's why spreadsheets are nice. Spreadsheets are nice. So then we're going to say that the payment that we're going to make each year is going to be equal to the amount. Let's pull it from here. We already calculated the payment. So there's the payment. And then we know what the interest is going to be. The interest is going to be the 11,000 balance times the 5%. That's the rent that we're paying on the borrowed money. So this is going to be equal to the 11,000 K3 times left, up to the 5%, enter. So that means that we're going to be paying the 1,901 about. There might be pennies involved here. We've rounded it. And the interest related to it is 550. So that means of the 1,901, 550 is like going to rent. It's gone. We're not getting any decrease in the loan balance from it. The difference between the two is the decrease in the principal that we will have. So we're going to say the loan decrease is the amount we pay minus the rent on it, the interest. And so that 1,351 about is what the loan balance actually goes down by. So this is going to be equal to the 11,000 minus that 1,351. So now the loan balance is going down to here. So if you were to record this, say, in an accounting ledger or something, you would have to decrease cash of the 1,901. Interest would be like kind of rent. It would be an expense. and then the loan would decrease by the 1,351. There would be 3 accounts affected, in essence, bringing your loan balance down to 9,649 and recording the interest expense at the 550, which would bring down your net income. Okay, so let's do it again. The payment would then be, once again, 1,901. Now, in a future presentation, we'll do this with monthly payments, which will be a bit more complicated because we'll have to deal with the added periods. So we will do that in a future presentation. It's not too much more complication once you get this down. So this is going to be equal to the 9,649 times the 5%. Notice that the interest will go down because that's how the loan was set up. So most loans are actually set up in this format so you can have nice even payments. That's easy for individuals and companies to budget. But the sacrifice on that is the fact that you got this funny business happening between the interest and the decrease in the loan balance as it goes down, it has a different amount each time due to this. So the payment's the same, but now the interest is different. So now I got to take the payment minus the interest. That means the decrease in the loan balance is now different. So the interest will always be going down because we're borrowing less money at this point in time. So we're paying less rent on that money. And that means we're paying the same amount. So that means that we actually have a bigger decrease in the principal as the loan continues on into the future. So this will be equal to the 9,649 minus the 1,419. Let's do it a couple more times, and then we'll use our autofill feature to copy it down. This equals the 1,901. This equals the 8,230 times the rate of the 5%. And then we have the difference, the 1,901 payment minus the interest, which is now at 412, gives us the decrease in the loan balance of the 1,489. That means the prior loan balance of the 8,230 minus the 1,489 gives us the new loan balance that we still have outstanding is at the 6,741 about. So we're going to pay, once again, the 1,901 in year 4. Now the interest is going to be the 6,741 times the rate, which is 5%. And so we paid the same amount, 1,901, but the rent or interest has gone down, 337, meaning the decrease in the loan goes up. And our prior loan balance was the 6,741 minus the 1,564. So new loan balance, 5,177. Let's do it one more time, and then we'll go back up and do it the easy way instead of this way. I'm going to hit this one, then say tab instead of enter, and then equals, that takes us to the cell to the right, equals the prior balance times the 5% tab, and then this equals the amount we paid minus the interest tab, and this equals the one above it, the 5,177 minus the 1,642, and that gives us the new loan balance of the 3,535. Now, before we end this thing off, because we should be at 0 at the end, and we would get there, but we're going to start over the suspense just to maintain the suspense. And then we're going to do it again, this time using autofill to make it, don't do it easy, do it the easy way. So I'm going to delete this whole thing. No, all that work was wasted. Okay, we'll do it again. It's okay. It's okay. So we're going to say this is going to equal the payment, which is over here. Notice that's from somewhere outside the table. When I copy it down, I don't want that cell to move down. So I'm going to say F4 on the keyboard, $sign before the E and the 5. You only need one $sign or a mixed reference, but absolute works. Then we've got the interest calculation, which is going to be equal to the 11,000 times the rate. Note that the rate is outside the table, which once again means that I don't want it to move down when I copy it down. So I'm going to make that an absolute reference, hitting the F4 on the keyboard, or you can put a $sign before the B and the 2. You only need a mixed reference again, but absolute is easy to think about. Then we can subtract these two out. This is going to be equal to the 1,901 minus the 550. Those are both within our table, and I do want them to copy down relatively and move down properly like they normally do, so I don't need to do anything to them. And then this is going to be equal to the one above it minus the one to the left, and I want those both to move down relative. Nothing's outside the table there, so that one should do as we want it to. So let's go ahead and then select these and auto-fill it down, grabbing fill handle, dragging it down. If you do this properly, the bottom line number should be 0. That's your indication that you've done this correctly. And this can help you to actually record your payments, breaking out the proper amount of interest and principal, and double check what your principal balance will be, as well as give you help in terms of what your interest payments will be. Interest is going to be something that's going to have an impact on your income statement, and you could have tax impacts on that because it'll typically be the deductible portion of the payment. All right, now let's do this one more time with the table over here. You might say, how can I do this with the table? Because the tables are usually used to give us basically the present value calculation. So now I'm going to use a present value of an annuity calculation to back in to a number on the table, which is something you probably wouldn't need to do in practice because you do it in Excel, but some nefarious teacher or something, school, might make you use the tables in this odd way. And so we can say we can do it. It's not hard. We just do our same table thing. We're going to say payment. We got the payment, then the amount from the table, and then the present value of the annuity. This is how we usually use the tables. What we're going to do is now we know what the end result is, so I'm not going to rework the algebra. I'm going to say, well, the end result is going to be that 11,000, and then I'm going to get the amount from the table, and then I can back into the payment from it. So we're just going to, that's why it's yellow. That's why I made it yellow, because we're going to back into the payment. So I'm going to say the amount from the table. We got to make sure we get the right table. This is an annuity table, present value. Same thing we did kind of up top, present value of the annuity. So we're going to use a percent and the number of years. So 5% and 7. Here's the 5. There's the 7. 5.7864, 5.7864, 5.7864, 5.7864. And then we can back into this. So if this times this equals that, I should be able to take then this equals the 11,000 divided by that. And obviously you can write it down and work it out algebraically. You could double check it and say, did I do it right? If I take this times this, I should get 11,000. I did do it right. Okay, so there's that. So we can do that. We can use those tables. And again, be aware that the tables can be used in such nefarious ways for test purposes, and then know how to do it like the easy way for actual practice when you're kind of figuring this stuff out.